Let me start this video with a simple question. 20 years ago, if a company were to promote its product or service, what platforms would it use? Well, it could be newspaper, pamphlets, billboards, posters, or if it has more money, then it would place an ad on TV, isn't it? But there was one problem with these traditional marketing platforms. Let's say you want to sell a car and you are targeting people in the age group 30 to 40. Now, if you go with a traditional ad like pamphlet or billboard or newspaper or TV, you don't know if that ad is seen by your target audience. Moreover, you will never know if the person is coming from seeing your ad on newspaper or billboard or pamphlet, isn't it? So basically, you could not quantify the return on investment on your marketing spend using traditional platform. But friends, the time has changed. Today, we live in a connected world where billions of devices are connected to each other, generating humongous data points about our preference, interest, and activities. And there are companies that use these data points, apply their algorithms to generate deep consumer insights, which is one of the greatest assets of 21st century. This has created an entire new marketing industry called digital marketing. Hey everyone, welcome to the second episode of the next multibagger series. In this video, we will discuss the business of a small cap company that generates consumer insight and uses it for digital marketing. I'm talking about Affle India. But before we proceed further, let me clarify that this video is only for educational purpose. And I've already created a video on who should watch this next multibagger series and what parameters I look for before shortlisting a company. If you haven't watched that video, then watch it first. Alright, in this video we will discuss 5 points that include first, Affle India business model and its future growth prospect. This will clearly help you understand why I say that Affle India is a future multibagger. Second, we will cover company's key strength and risk that would help the company sustain and grow for the next 20-30 years. Then we will look at leadership, financials, and finally the valuation. Based on these 5 parameters, we will give a score to Affle India. Alright, let's get started. Established in 2005, Affle India uses a proprietary consumer intelligence platform that delivers consumer acquisition, engagements, and transaction through relevant mobile advertising. So basically, this company helps global brands enhance return on marketing investment through contextual mobile ads and also by reducing digital ad fraud. Here, contextual ad means the ads are placed as per user interest. Affle India uses artificial intelligence, machine learning, and deep learning to generate consumer insight for better targeted marketing. Now let us try to understand how Affle India earn revenue. As discussed before, Affle is in the business of digital marketing where it has its own proprietary algorithm that churns consumer data and generate insights for relevant digital marketing for its client. Now you might wonder, isn't it similar to other digital marketing companies? So try to understand this. There are 2 types of digital marketing companies. First are the likes of Google and Meta that have their own algorithm and generate insights and help in targeted marketing. Second are those digital marketing agencies that uses Google, Meta, etc. to help their clients with setting up digital ads. And there are thousands of such digital marketing agencies in India in every city and town. Affle fall into first category where it has its own algorithm and consumer data points. So it directly helps businesses in their digital marketing campaign. So it is competing against Google and Meta. But interestingly, the business model of Affle is unique. Unlike other players who charge advertisers for clicks and impression, Affle revenue is based on driving conversions. Affle inserts digital advertisement in any app or website that users go to regular basis on the insights it generates from huge amount of consumer data points. But it charges advertiser only on CPCU basis, that is cost per converted user. After the user clicks on the advertisement, goes to the app store, download the app and launches it on the mobile device. This CPCU, that is cost per converted user model, accounts for 90% of Affle revenue. Since the conversion is deeper, the return on investment accountability with advertisers is significantly high. Let's understand this CPCU model. So this chart on screen shows CPCU business Q2 performance trend year on year. And the CPCU revenue is calculated by multiplying converted user with average CPCU. So in Q2 of FY21, company converted 28.1 million users and its average cost was 40.3. That turned out to be 113 crore. So this is 113.2 crore. In Q2 of FY22, it was 48.7 and average cost was 51.3. That turned out to be nearly 250 crore. And then in Q2 of FY23, company converted 64.7 million user and average cost was 51. So its CPCU revenue has turned out to be 329 crore. Now in the future, company would generate more and more CPCU revenue by increasing the converted user as well as increasing the average cost per user. Now before we proceed, we have a partner for this video. It's mstock by Mirai Asset. mstock is a trading platform that is disrupting the traditional brokerage sector with its zero brokerage model. All you need to do is pay a one-time fee of $999 and you can make unlimited trades without any brokerage. It includes free intraday trading, free delivery, free F&O trades, basically everything free for just one-time fee of $999. And if you open a Demat account with mstock, you just need to pay a one-time amount of $999 and your Demat maintenance would also be free for life. So basically you pay a total of $1998 and all your trading is free and your Demat maintenance is free for life. And since mstock is a part of global Mirai Asset Group, it brings 25 years of legacy and experience of 15 countries. mstock platform is built on advanced technology that can process thousands of orders per second and provides you with a stable platform and a seamless experience. This is a great option for those who trade frequently and even for investors who are looking for an alternative low-cost trading account. mstock also has launched margin trading facility at an interest rate of 7.99 to 9.49%, which is one of the lowest in the industry. If you want to explore mstock, I have provided the link in the description box. So the CPCU revenue model that we discussed fall under the consumer platform segment where Affle shows relevant ads to consumer. This segment contributed the most with 99.3% of H1 of FY23 revenue. Remaining business comes from enterprise platform where Affle enables offline businesses to go online through mobile apps development, building e-commerce website and apps, and also provide data analytics services to generate better insights. Now if you look at the revenue breakup by geography, India contributed 31.1% in its revenue in H1 of FY23 and remaining 68.9% is from international market with focus on emerging markets like Africa, Latin America, Vietnam, Thailand, etc. Now as far as future growth is concerned, it is a no-brainer that the future of digital marketing is very bright. Although there is already a strong adoption of digital marketing in developed countries, there is still a huge scope for growth in emerging markets. As per research, global digital ad market is expected to grow by 9% and emerging markets like India are expected to grow at 25 to 30% CAGR. Today, India has a majority of population in the age bracket of 18 to 30 and these people prefer smartphones to communicate. And since more and more consumers are preferring to use smartphones to interact with digital platforms across your e-commerce, OTT, fintech, online gaming, healthcare, telecom, education, etc., this in turn is driving the need for advertisers to reach consumer on smartphones and adopt omni-channel marketing strategy. Hence, every company is exploring the digital marketing channel to promote their products and services. And this trend would continue to grow in the future. Now, if you look at the digital advertising industry in India, it has increased exponentially from 47 billion in FY15 to 160 billion by FY19 and expected to reach 539 billion by FY24, representing a CAGR growth of 27%. Although in the near future, since the global economy is facing slowdown, it can result in fall in ad spend. Now the question is, can it impact Affle India business in the short term? I also had the same question and I did my research. In fact, I found a recent interview post Q2 result where this exact question was asked to Mr. Anuj, the founder and chairman of Affle India. And he said that there are headwinds in developed markets like US and Europe and we are not insulated from that. But we are in a privileged position because 80% plus of our business is anchored in India and emerging market. Global emerging markets are still showing consistent growth. In fact, if at all companies would have to reduce their advertising budget, it would be mainly from traditional marketing platform. And companies would focus more towards digital advertising where Affle is well positioned with its ROI driven business model. I hope you remember the CPCU model that we covered earlier. Yes, there can be some specific sectors that might see fall in budget for ad spend. For example, after a crazy jump post-COVID, edutech and fintech sector is now facing slowdown. So these sectors have seen fall in their ad spend. However, Affle India caters to broad business with thousands of advertisers. So considering all this, for H2 that is Q3 and Q4, Affle India management is expecting a 10% incremental growth as compared to H1. And for long term, we discussed there is a potential to grow at 25 to 30% CAGR rate. Overall, on company business and future growth prospect, I would rate it 10 on 10. Now, if you look at the key strength, its first strength is proprietary algorithm. Affle consumer platform has approximately 2.8 billion consumer profile that drives its predictive optimization algorithm. This is the core of its business, which helps Affle in right target marketing. Affle proprietary algorithm generates insights from these billions of data points to help enterprises reach right set of consumer to optimize their ROI. Company has filed 20 patents, out of which 6 patents have been granted. And I always say that patents are the most important aspect while analyzing a tech stock. It's the patents that shows real innovation and create a moat around the tech company. Hence, I'm very positive on sustainability and growth of Affle India. Then second strength is asset light model. The best part of this company's business model is that it is a technology based asset light company and hence the expenses are minimal. On the other side, due to technology, the scalability potential is immense. Its third strength is ROI driven business model. While the current digital marketing industry charges clients based on clicks, views and impression, Affle India uses a ROI driven CPCU model where it charges clients on actual conversion that sets them apart from its competitor. Now if you look at the key risk, first risk is regulatory risk. Try to understand this. Affle collect a lot of consumer data points. But what if there are new regulations around consumer data protection that restrict Affle India to collect data from various sources? It can have an adverse effect on its business. Second risk is technology risk. If Affle failed to predict an engagement by consumer with mobile ads with a sufficient degree of accuracy, it could have an adverse effect on its business. Then third risk is competition risk. The market in which Affle operates is intensely competitive. Although it is dominated by digital giants such as Google and Meta, there are over 100 companies around the world who offer one or more component of this solution. However, only a few companies operate internationally, including Affle, InMobi, Criteo, Trade Desk, etc. Although it is not easy for global companies to operate in India. First of all, India is a price-sensitive market and the cost per conversion in India is very low as compared to other developed countries. Second, India has a very different demographic. It is not easy to identify the shopping pattern of Indians. So companies that are familiar with the dynamics of consumer profile and have a track record of working alongside brands locally for years would have an edge over competitor. And that's where I think Affle is in a sweet spot. Overall, looking at the key strength, risk and competition, I would rate Affle 8 on 10. Mr. Anuj Khanna Soham is the chairman, MD and CEO of Affle India. He is a technopreneur with over 20 years of experience in technology business. He has completed his bachelor's degree in computer engineering from National Institute of Singapore on a full scholarship. He has also completed the Stanford Execution Program from Stanford University and Owner-President Management Program from Harvard Business School. What I really liked about Mr. Anuj is he is very clear that the enterprise has to be consistently profitable and cash flow positive. He says, we are not of the DNA that says, let's get investors' money and get growth. We are not wired like that. Business is about profits and being cash flow positive. And that is the reason, unlike the new age tech companies that are burning cash, Affle India has been profitable from day one. Hence, on leadership, I would rate it 10 on 10. Now if you look at Affle India revenue growth, it is consistently growing from 2018. It was 167, then grown to 249, 334 and latest is 1357. So basically since 2018, the revenue has grown almost 8 times. It means since 2018, the revenues have grown almost 8 times. Next, if you look at the profit growth, profits have grown from 28 crore to 49, 66, 135, 215 and latest 245 crore. So since 2018, profits of the company have grown more than 10 times. Now if you look at margins, margins have been on the higher side. Although it was 25%, from there fell down to 20% and latest margins are at 19%, which is pretty good. Next, if you look at the ROE and ROCE, so latest ROE and ROCE is around 18-20%, which is pretty good. Then if you look at the debt structure, Affle India latest debt to equity is 0.1, which is negligible. And finally, when we look at cash from operation, Affle India cash position has consistently grown in last 4.5 years and latest cash position is 206 crore in March 22. Overall on financials, I would rate it 10 on 10. Now let us look at the valuation. Currently, Affle India is trading at levels of 1230. and its share price jumped multifold times since its IPO. However, it has been sort of consolidating in last 1 year. At current levels, Affle India is currently trading at P ratio of 67.4. Now you can't just look at P ratio to decide the valuation. Here, earning plays a very important role. A company with high earning potential will command a high PE. And considering the fact that Affle India earnings have grown at CAGR rate of 60% in last 5 years and has potential to grow at 25 to 30% CAGR in the future, company would command a premium valuation. So considering the earning growth, the valuations are not crazy high. Hence, on valuation, I would rate it 7 on 10. Even at current levels, it is worth adding this stock in the portfolio. But due to any negative news or global slowdown, if there's a correction in share price in near future, it would be worth adding this stock. Even DIs have increased their shareholding in Affle from 6.37 to 7.51 to 9.13. Although FIs have slightly reduced their holding from 14.69 to 14.2. Overall, Affle India is a SIP grade stock. So in this video, we covered the fundamentals of Affle India. If I summarize the score, on business model and growth prospect, I have rated it 10 on 10. On key strength, risk and competition, I have rated it 8 on 10. On leadership, I have rated it 10 on 10. On financials, I have rated it 10 on 10. And on valuation, I have rated it 7 on 10. So that's a total score of 45 out of 50. Now tell me, what is your view on Affle India? Have you invested in this company? I hope you find this video useful. I'll see you next video. Till then, take care.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.